Hello, fellow Rebel Capitals. Hope you're well. Jerome Powell just came out and made a huge announcement the market's been waiting for. Well, it's a huge announcement, but it was pretty much expected. He kept rates the same. So we're in a rate cutting cycle, but once again, Jerome Powell and the Federal Reserve paused. So the question becomes, how did markets respond, especially the bond market? And what is he likely going to do next and throughout the rest of 2025? So let's shoot straight over to CNBC, check out the details. Usually when there's like a 97% chance that the Fed keeps rates the same, it's all about Jerome Powell's remarks after he comes out and makes the main announcement. So are his remarks hawkish? Are they fetish? Or are they fetish? That was a good slip, wasn't it? Are they hawkish? Are they bearish or fetish? Whichever one you prefer. But before I dig myself into a deeper hole, let's shoot straight over to CNBC and try to check out the details here and then connect some dots. So going over there right now, let me go ahead and refresh. And oh, my mic's too high. So the Dow, so the Dow looks like it's responding pretty well because going into this, I think it was right around 100 points up. And so we're up a bit, almost 400 points. S&P 500 up about 40. NASDAQ trailing the Dow, which is kind of surprising, at 0.62%. But look at the VIX, guys. The VIX is still above 20. So if you are a bull, that's not good. That's not good. If you're a bull, you'd like this to be under 20. So the big key, in my view, is the bond market. So the 10-year Treasury yield trading down about 4 basis points. But look at what the 2-year is doing. I think we're having a bigger move in the 2-year because I know that was up prior to the Fed making an announcement. So now we've got the 2-year Treasury. Well, it's just down slightly, almost flat. So not too much of a move. I guess we're seeing more of a move at the long end of the curve. So here's the 30. Yeah, 30's down on the day, just I guess a basis point or two. So a bigger move than at the front end, but overall, not that much volatility. And then the dollar, it looks like it's up on the day. The dollar shot up, interestingly, when Jerome Powell, I guess, made the decision. Dollar shot up to 99.77. So, we had that big move down. Now we've kind of settled around 100, it seems. Let's kind of zoom out to see what's doing here. Yeah, trend is down for sure. But I can assure you of one thing, the dollar is not, quote unquote, collapsing. You guys know my view. I don't know that we'll be up at 110 anytime soon, but I don't think we're going to be down below 90 anytime soon either. I think the risk, the extreme risk, is to the upside, not the downside. Getting back, let's see what gold did. Very curious. Okay. So gold slips a little bit. I think that's just probably maybe profit taking because we've had such a huge move. Let's look at a chart. I don't know why the Fed's decision would have made that much of a difference, although it looks like you are getting into some resistance here, so we'll have to see how that plays out. But what I'd like to do, so let's look at Bitcoin. I think that was up on the day, and oil, probably even more importantly than yields, down still into the 50s. You're at 58. It was way down the other day, then it kind of bounced back up close to 60, and now we're down a little under 58, 57.92. And this is just pretty much demand side as far as I can tell. And that just tells you not just about the United States, but of course the global economy, and that the oil market is predicting that demand is going to go down. That means economic contraction. Let's go over to Bloomberg and see what their take is. Actually, before we do that, let me go over and see if I can find some of Powell's remarks. That would be helpful. I think those are the insights we want. Let's see, Giants Fed decision, meeting recap. Okay, let's do that. So Federal Reserve kept interest rates the same. Okay, got that. The risks of higher unemployment and higher inflation have risen. Okay, so my good buddy Peter Schiff tweeted out, basically, this tells us that we're headed for stagflation. So higher unemployment and higher interest rates, higher unemployment and higher CPI. Now, the thing, and I've got a ton of respect for Peter, but this is one particular view that I completely disagree with, because I cannot find a time in U.S. history, pretty much, at least modern history, where we had a higher CPI at the end of a recession than we had at the beginning of a recession. It's just, I know it's very counterintuitive because people think, oh, well, there's all this money printing, or, oh, well, we're going to have tariffs and all these. Yeah, but I mean, we had the oil price just skyrocketing in the 1970s, as an example. That's an input to absolutely everything. So I would argue that higher oil prices would have just as much of or give inflation just as much of a tailwind as the tariffs themselves. Another thing you got to keep in mind, it's not like tariffs make prices go higher and higher and higher and higher. Let's just assume for a moment that Trump puts a 25% tariff on automobiles. Okay, so that increases the price by 25%. But after that, it's done. There's no, okay, now it's going to 30% and 35 and 40 and 50 and blah, 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 blah. No, you bump it up to 25 and the prices of those things goes up, but then the aggregate demand goes down because people's paychecks don't go up at the same rate. And so even if you do have that bump in inflation in some of the goods, after that, you usually see the disinflation, which I think is very similar to what we saw in the 1970s. And ironically, that's what everyone uses as a proxy or as an example as what they think we're going to see today with a recession, or when interest rates, I keep saying interest rates, when the CPI spikes and we get unemployment spiking, and it's kind of this like emerging market type phenomenon. But we've never seen it. So I don't know why this time it would be any different. Let me show you what I'm referring to specifically, because this is really the narrative that I see that's being pushed, and kind of the most prominent narrative on Twitter as an example. So first and foremost, those are my messages. Okay. First and foremost, let's go over to right here. And this is what Peter's talking about. He says, in leaving interest rates unchanged, the Fed admitted risks to higher unemployment and higher inflation have risen. It's not just the risk that has risen. Higher unemployment, higher inflation are all but guaranteed. I don't want to pick on Peter, and he's a great dude. But this is something that I strongly disagree with him. I think that, yeah, the probability is that we do have a recession, but the odds of the recession ending with the CPI higher than when it begins, the odds are incredibly, incredibly low. And what you'd have to say if you had a different view, like, oh, well, this time it's going to be different, you have to tell me why it's going to be different. It's not tariffs, because you had the oil shock back in the 1970s. And it's not money printing, because if you look at the growth of M2 money supply, it actually grew in percentage terms much more from 1970 to 1974 than it did to 2020 to 2024, right? So let's just actually go over some charts here, because I don't want to just make these claims without backing it up with the data. At the end of the day, that's all I'm really doing here. When I come out and do these videos, it's very rare that I'm just giving you my, pontificating just right off the top of my head. If I have a strong position, I can almost assure you it's going to be backed up by data. So let's go back to, look at this. You guys remember, well, you might not remember that, but you might remember reading about it in history. Let's just go back to oil because that's probably the best analogy that I would have to what you may see with tariffs, where the price of oil, and this is inflation adjusted. Yeah, it is. So inflation adjusted, the price of oil went from, call it $70 straight. Oh, I'm at the wrong time frame, aren't I? That was another. There we go. Okay, so we had the price of oil going from $25, just straight up to 70. Think about that. That would be like the price of oil. What is it? We're at 50 today. That's like it just going boom, straight to 150 almost overnight. So this is very similar as far as from an economic standpoint as to what you would see with tariffs. Because again, oil is an input to almost every single good that we consume in the United States. So you had this, which is, I think, it's not the exact same as tariffs, but like we said, very similar. So now let's look at M2 money supply from 70 to 74. And it's represented by this black line. So right here, this is the, let's do total increase. That's right down here. So let's zoom in on 70 right there, roughly. And then we're going down to 74. Okay. So from August of 69, okay, let's tidy it up a little bit. There we go. So from July 1970 to October 1974, we had an increase of M2 money supply. Total, we had plus 49%. So just call it roughly 50%. Okay, great. Now let's go ahead and fast forward to today from 20 to 24. And right here, we're October 19th. February. If I can get to the summer, it's not going to change much. And if anything, it's going to go down. But you saw the maximum that we had there as far as an increase of M2 based on the month that you're using was about 40%. So that's still, and if we go from April 2020 to July 2024, we had an increase of M2 total by 24%. That's way less. Even with this huge bump that everyone talks about from 20 to 22, it's still way less, quote unquote, money printing than we saw back in the 1970s. But let's look at the recessions of the 1970s and zoom in for you guys so it's easier to see. And here you go. So, like I said, when you get a recession, when you this doesn't show the recessions, does it? Dang it. Well, we know the recession started right. Oh, this is 73. It would have started in 74. So at the start of this recession, at the beginning of the 1970s, inflation, CPI, right around 10%. Okay. Now we go to the end of the recession, which was 75. We'll call it the end of 75. And we're down. I'm right here. We're still lower. We're already at 7.3. And then if you continue out even after the recession, it's disinflationary for the next year, year and a half, to the point where you get to 4.8. Now, that's still high. Don't get me wrong. That's still high. but your end point is always lower than your starting point, even in the 1970s. So let's assume for a moment our starting point is where we are right now, 2.4%. Okay, well, that, that means, let's say at the end of a recession, assuming we have one in 2025, let's just say we're at 1.5. Now, during the recession, the CPI might go up to 3%, something like that, temporarily, and then come back down, due to tariffs or something. But you see what I'm saying? It's you can zoom out as far as you want, and you can't find a recession, that's combined with an unemployment spike, where the CPI ends higher than where it started. It just doesn't happen. And it doesn't matter whether you have a supply shock or oil shock. It doesn't matter where you have a massive M2 money supply growth. In fact, if you want to look at inflationary factors, I would say that you have more inflationary factors, or you had more from 70 to 74 than you did from 20 to 24. But yet the recessions were still disinflationary. So I just want to make sure that when we're looking at what the Fed is saying here, and that the reason they're pausing, I mean, that's really what I'm getting at here, guys, is the reason they're pausing is because they're saying, okay, well, we're okay on the unemployment rate. We're worried about it increasing, but we're also worried about inflation increasing. That is, in my view, complete nonsense, and it's totally ignoring history. And by the way, it's not like you go back over the past 10 recessions and like 6 of them were disinflationary and 4 of them were kind of right on the borderline. No, every single one. So, I mean, if it happens, or if it has happened 100% of the time in the modern age, since the Fed was created, or what, 1913, if it's happened every single time that way, why would you base monetary policy on this time it being different? It makes no sense to me at all. The risks of higher unemployment and higher inflation have risen. But I'm trying to give them the benefit of the doubt. So if you look at the entire 1970s, it is true. You had high rates of overall employment and high rates of inflation, but you didn't have them spiking at the same time. There's an inverse relationship there. So if you have the unemployment spiking, even in the 1970s, inflation is coming down. You have disinflation. So inverse relationship. So you can have, or if you zoom out over a whole 10-year period, you can have both high rates of inflation, high rates of unemployment. But when you get focused on the unemployment spike within a recession, there's always an inverse relationship between the two. The central bank is walking a fine line. It's facing uncertainty about Trump, tariffs. I mean, they're granted, there's a lot of uncertainty. I'll give them that. But is there a lot of uncertainty regarding the unemployment rate? Come on. Like, and I want to be very clear. I'm not saying the CPI can't go above 3% or can't go above where it is today. Sure, yeah, if you get, especially if you get some crazy supply shocks. But that doesn't mean that we have to worry about runaway inflation. And that's what the Fed is trying to protect against. In their minds, it's their job to make sure we don't have runaway inflation. If we have a bump of 10% and then a flat line and then kind of back down slightly, you have a one-time price adjustment. The Fed has no control over that. Let's think about this for a moment. And for this thought experiment, I want to go over to my Twitter feed. This is very important, probably the most important thing that we're going to talk about today. It's right here. This is the overall curve, guys, as of this morning. So the Treasury curve. So we start here with Fed funds, as you guys know, right around 4.3. And then the 1 month Treasuries right here. So this dot is the 1 month yield, 2 month yield, 3 month yield, 4 month yield, 6 month yield, 1 year yield, 2 year yield, 3 year yield. So our lowest point in the curve right now is the 3-year Treasury. And then we go up. The 10-year is right here, slightly below, slightly above Fed funds. Is it above? Well, I think it's slightly below, but we'll just call it flat. And then we go up here to the 20 and the 30. So because I think the market participants, CNBC, Bloomberg, FinTwit, all these people like to talk as though the Fed just controls interest rates. Like it's this monolith it controls. The Fed doesn't control interest rates. The Fed controls the Fed funds rate. If that, and I would argue, I don't even know if they control that because they just follow the 2-year. So if they're just following a market rate, or do they really control it? But I'll save that for another video. But if anything, they control from, let's say, the 1 month or the overnight rate to the 6 month rate, right? Because after that, the 1 year, it's way below Fed funds. It's already way below. So if the Fed pauses, right, like they did today, what does that actually do? Or if the Fed would have cut, what does that actually do? Well, if they pause, then let's just call it the 1 month to the 6 month, pretty much stays the same. Okay, how does that impact inflation? Like you're telling me that there's going to be a dramatic difference with inflation if the 1 month to 6 month T-bill is plus or minus 25 basis points. Huh? Like, who would argue that? Nobody in their right mind. Yet for some reason, we look at the Fed as though they're the end-all, the be-all, end-all when it comes to interest rates and inflation. It's like, what are you talking about? Or employment, same thing. Like what employer is going to not hire someone or hire someone based on the fact that the 1 month to 6 month T-bill is plus or minus 25 basis points? This is nonsense. This is kabuki theater. But yet everyone is in on the ruse. And I just can't believe that these market commentators and quote unquote experts don't sit there and point and say, hey, look, the emperor ain't wearing any clothes. I mean, I don't know how this can be any more commonsensical, right? So now let's think about it in terms of tariffs. So let's just assume that Donald Trump puts a 25% tariff on cars coming into the United States. Okay, so you're telling me that the inflation rate, the CPI, is somehow going to be different on the basket of goods or just on the cars coming into the United States. It's somehow going to be different if the 1 to 6 month T-bill is plus or minus 25 basis points. So let's just assume that those $50,000 cars that are coming in now cost whatever, $62,500, okay, because of the tariff. You're telling me that the price is going to go down because the 6 month or the 1 month to 6 month T-bill is at, call it 4.35 instead of 4.15 or 4. Come on. What are we doing here? This is crazy. This is craziness. But yet, for some reason, we just think that there's only one interest rate, and that's Fed funds. And that if it's this high, well, oh my gosh, that's going to make sure that we never have inflation. But if it's right here, oh my gosh, we're going to have runaway inflation. It's going to be hyperinflation. The Fed's lost control of everything. When in reality, the only thing that they're doing is just slightly adjusting the overnight rate to the 6-month T-bill, for heaven's sakes. And if you want to say, oh my gosh, that really impacts borrowing costs, does it? The 1 month T-bill impacts borrowing costs? I mean, I don't know, maybe for just a huge corporation that's rolling over paper. But in the real economy, I mean, you're telling me that impacts how much you're going to pay on a car loan or how much you're going to pay on credit card debt? I mean, maybe the front end, but I think with credit card debt, it's far more a risk premium that makes the interest rate skyrocket than Fed funds. But you're talking about a home loan that's somehow going to go way up or down based on the 1 month T-bill? Of course not. So my point here is that 90% of the interest rates that actually matter in the real economy when it comes to inflation, disinflation, deflation, the Fed doesn't even control them. And it's obvious by looking at this curve. But yet, for some reason, even the experts out there just get hyper-focused on every single little word that comes out of Jerome Powell's mouth, as if there's just a huge impact to the level of prices and the unemployment rate if Jerome Powell goes from 4.3 or 4.25 or whatever it is down to 4%, when the whole entire curve doesn't even move if he does that. I mean, it's like Zoolander. I'm like Magatu. I feel like I'm taking crazy pills. So let's get back to the all-powerful Fed. Ooh. Jerome Powell knocked down any notion taking preemptive rate cuts as inflation is still running above target. I mean, when you see this chart and you go back to listening to what Jerome Powell said, it's laughable. It's like, who does this guy think he is? Like talking about having a lack of self-awareness. But in Jerome Powell's defense, I think he knows that the only thing he has is kabuki theater. That's it. Because mechanically, his little interest rates don't really do anything. And mechanically, his balance sheet doesn't really do anything. So the only power that he has is to try to make you believe he does have power. That's it. It's a psyop. That's the only tool in their toolkit, other than being able to bail out banks and whatnot. But really, that's the tool in their toolkit. It's psychological operations. And what frustrates me is so many people, like, it's so obvious that this is what they're doing. And mechanically, they really don't do anything. It's so obvious, but yet so many people just ignore that fact. And they don't even want to think about it because it's almost like cognitive dissonance. Like their whole entire worldview is based around the Fed controlling interest rates, the Fed controlling inflation, the Fed controlling the unemployment rate. And therefore, since their entire worldview is based on that, they can't even entertain the idea, even though it's right in front of their face, that the Fed might not control those things. And then Jerome Powell just plays on that. I mean, he's a one-trick pony, meaning Jerome Powell and the Fed, but their one trick is really, really good. And people just allow him to continue to get away with this. It's the emperor. Okay, here's a quote. It seems to be we're entertaining a new phase or entering a new phase where the administration is beginning talks with number of important blah, blah, blah. Okay, we get that. It's going to be very important how this shakes out. Okay. Powell said tariffs implemented April 2nd were substantially larger. All right, but now that we've got a 90-day pause, you don't know what's going to happen. But even so, how are these tariffs? I would like him to explain that. Let's just go back in history, Jerome, and how are these tariffs any different than what we saw in the early 1970s with the spike in oil prices? Now, I guess, just to play devil's advocate here, or in his defense, you could say, well, we didn't have a massive supply shock. But I mean, in a way, we did. I mean, those of you that were alive in the 1970s, you remember gas lines, right? That's a supply shock in my book. I mean, I just wish he would defend his position through history as opposed to defending his position as if history never happened and as if there's nothing to learn from history. That's probably my biggest pet peeve. Then he's just talking about he's independent, never asked for a meeting with Trump and blah, blah, blah. Okay. So let's now go over to the CME, guys, and see what the odds are of the Fed cutting next meeting. And then also how many rate cuts we're going to get here in 2025. And this is not George Gammon's prediction. Just want to be clear. This is just the CME Fed Watch. So 41 days to the next meeting. And right now we're at is that right? We're at a 23% chance they cut and a 76% chance they pause. Wow. And another thing I want to point out, guys, just quickly, and I'm going to get back to the CME Group here, is I know it's easy for Americans just to get hyper-focused on the United States for obvious reasons. But if you look around the world, I mean, central banks are cutting interest rates right and left. As a matter of fact, I was listening to Snyder, and he pays attention to the global central banks even more than I do. But his base case is, and he's been spot on about the Swiss National Bank, but his base case is they'll be at negative again within 6 months, maybe sooner. In fact, I don't think he said he'd be surprised if they go negative their very next meeting. So let's just look at and I know a lot of you right now are saying, oh, that's crazy talk. There's no way. That's never going to happen. But most of you probably don't know that their current rate is 0.25%. So currently, the overnight rate for the Swiss National Bank has been cut from 1.75% down to 0.25%. So if they do another 50 basis points, in fact, if they do another 30 basis points, they're negative. Negative again. So now let's go back to Bloomberg and look at, this is just the central bank column. And we've got right here, Mexico, slowing economy gives Banxico space to cut key rate, official says. So they're cutting rates, or they're becoming more dovish, let's say. Tanzania. Okay, they're Africa's worst currency. That's nice. The Czech central bank cut rates, but keeps a hawkish tone. All right, okay. Polish central bank cuts rates. Philippines says they're open to a 75 basis point cut over the rest of the year. China cuts key rate. Swede Bank now forecasts more easing from Riksbank. So my point is, when you go down the list of global central banks, almost every single one of them is cutting and becoming more and more dovish. Why is that? Is that because the global economy is booming? No, that's because the global economy is slowing down. It's just what you see in the price of oil, right? So is that inflationary? And also, when you look at the inflationary episodes that we've had in the United States over the last, call it 50 years, it's like globally, it's like global inflation. Like in the 1970s, it's not like the United States was the only country that had inflation. It was pretty much all the developed and developing economies. Same thing during 2021 and 2022. You know, outside of maybe Switzerland, and even their inflation rate went up. Even Japan's inflation rate has gone up. So it's what are the chances that the inflation rate in the global economy is decreasing, but yet at the same time the inflation rate in the United States is increasing? Or let's just say accelerating. Now, I'm not saying again that it can't go from 2.4 to 3 or maybe even 3.5 temporarily due to the price adjustments from tariffs or from the oil shock in the 1970s. But a price adjustment is a lot different than inflation accelerating, right? Accelerating, by definition, means you're going faster and faster and faster and faster and faster. That's not what this is. This is more like adjusting the cruise control to 50 when you're going 45 miles per hour. Once you get to 50, you're not accelerating. You're going the same speed. But the difference here is that demand destruction takes you from 50 miles per hour straight back down to 45 or even less. So when we look at things through the lens of the global economy, when we look at things through the lens of history, and then you look at this CME Group, and I'm not blaming them, it's just they're just presenting the data and what the market's predicting, and a 76.8% chance that the Fed pauses again in June. I mean, maybe, but I just don't know why they would. It doesn't make any sense to me at all. Why would you not? And I'm not saying that rate cuts would do that much, but I'm saying if you're in their shoes, why would you not cut rates? The risk is not with 1970s, or even if it was 1970s style inflation. We're still headed for disinflation, assuming the unemployment rate spikes. Let's keep going. So we're at June, July. So July, then now our highest probability is that they cut once between now and July. And then they cut twice from now to September. I'll take the under on that one. I'll take the under. And in fact, I just did take the under. For my Rebel Capitalist Pro members, we just put out an alert yesterday how I adjusted my portfolio accordingly, because I think that the Fed is off sides. And I think that if we fast forward to the end of this year, we're going to have more than 50 basis points of rate cuts. But that's just my opinion, not investment advice. And I could be wrong. We'll have to stay tuned and see how the data plays out. But you guys know from watching my videos, my base case ever since we had this Liberation Day is we would have Liberation Day, the market would tank, or after Liberation, the market would tank, continue to go down and down and down, and then we would have a pullback because Trump would reverse course. Would be like, oh, that didn't mean that, my bad. He's never going to say that. But he's like, oh, well, let's do a 90-day pause because this is art of the deal. I'm playing 5D chess. And then the market's going to see that, and then it's going to rip higher. And then we're going to transition from being all about tariffs to all about data softening, whether it's at a corporate level, whether it's the data coming out from the BLS, whether it's the data coming out from the Federal Reserve themselves, the macroeconomic data. In my view, my base case is it's going to get weaker, and then the market is going to go from getting hyper-focused just on the tariffs to, oh, wait a minute, those tariffs aren't that big of a deal. If anything, they're a catalyst. Let's start focusing more so on the softening data, and that's probably, or at least my base case, is when the market starts to roll over again and you go back into bear market territory, definitely when it becomes obvious, even to the talking heads, that the economy isn't as strong and isn't as resilient as they thought. And oh, wouldn't you know it, the interest rates in the Treasury curve were right again. All right, guys, enjoy the rest of your afternoon. As always, make sure you're staying up for freedom, liberty, free market capitalism. Make sure you are getting your tickets to rebelcapitalistlive.com, or that's at rebelcapitalistlive.com. It's coming up here. There you see some of the speakers. I don't know who this guy is on the left. You can go ahead and ignore him. But we've got Robert Barnes, McIntosh, Brent Johnson, Kenny McElroy, Jeff Snyder, Kiyosaki himself going to be there hanging out with everyone. Joseph Wang, Fed Guy, Rick Rule, Mike Maloney, Jason Hartman, and we'll have another awesome speaker there. It might be someone that knows a little bit about the monetary system and global macro. But you definitely want to get your tickets ASAP. You don't want to miss this, especially with the volatility that we'll probably see throughout the rest of 2025, even if I am wrong about inflation, interest rates, and the unemployment rate. And the greatest thing about this event is you get to rub elbows with the speakers, hang out with them, ask them questions, meet them face to face, shake their hand, and hang out and network with your other fellow Rebel Capitalists. So you don't want to miss it. Again, get your tickets at rebelcapitalistlive.com, and I'll see you on the next video.